the Jet Setting Wealth Advisory Podcast, where your financial journey takes flight with David T.U. As an airline pilot and financial expert, David merges the aviation industry and wealth management to help you navigate today's complex financial skies. Each episode features expert insight, blending personal stories with essential financial strategies. We ask that you fasten your seatbelts and sit back as we prepare for takeoff. Our destination, your financial empowerment.
Hello, everybody, and welcome back to the Jet Setting Wealth Advisory. I'm your host, David T.U. Today, we are joined by not one, but two trusted tax professionals from Goldstein Tax Advisors, a firm known for their personalized approach, deep expertise, and long-term client relationships with their clients and helping them mitigate taxes. Let's start first with Beth. Beth Goldstein is the owner of the firm, which she took over in 2020 after working alongside her father, Mr. Bob Goldstein, for over 14 years. Beth brings energy, compassion, and strategic insight to tax planning, especially for W-2 high-income earners and the self-employed. And she's passionate about helping clients build financial team that supports their long-term strategic financial goals. Next, Barry Kaufman, a CPA and partner at the firm, has been there for more than 15 years. He brings a wealth of experience working with small businesses and individuals on everything from multi-state taxation to rental real estate to equity compensation. He's known for his thoughtful practice, advice, and for helping clients go far beyond just filing in April. So, Beth and Barry, welcome to the show.
Thank you for having us.
Good to be here.
We are so delighted. We have a lot to talk about, just like we spoke about in the pre-recording. So let's get started. Beth, you continue your father's legacy and turn Goldstein Tax Advisors into a multi-state firm with clients around the globe. What keeps you passionate about this type of work, and what makes your firm different than others who call themselves tax advisors?
I feel what separates our firm from other firms is that we are extroverts that do taxes. My father brought a lot of personality and client relationship mindedness to the practice that he built. Anyone can do your taxes, but you should probably like the person you're working with and look forward to meeting them more than once a year. And really, our clients become people we like to engage with.
Okay.
I really admired the way he built his practice organically without having to advertise. And that is something we continue on, fortunately, and get to choose who we work with and make sure it's the right relationship, the right fit, because when both parties are happy, the success is endless.
Yeah, we try not to think of it as a seller and a buyer. We really feel that we're both buyers. We're both getting something out of it, not just the relationship with the taxes, but sometimes people move to Pittsburgh, which is where we're based out of, and we help them get acclimated for all kinds of things, handyman and places to go.
Wow. So you mentioned, Beth, extroverts in working in the tax realm.
Yes.
That is definitely a contradiction.
It is.
But yes, I completely with you. I think I'm like one of you in terms of
Here we are. We're all together.
Yeah. Let's talk to you, Barry. You've worked at several regional public accounting firms before joining Goldstein Tax Advisors. What drew you to this partnership, and what's been the most rewarding about working with Beth and the entire team?
Yeah, absolutely. So being with Beth is rewarding no matter if it was years ago or moments ago. But I worked at a lot of regional firms after I went to the University of Pittsburgh, and I really enjoyed that, got a lot of experience with things that I'm sure you've mentioned or we'll continue to talk about. But we've always been friends, and we played sports together. We were on some professional groups. And when her father passed away, it was just go time. We had to implement the strategy that we had already been discussing. And here we go. I'm here, and I'm really happy to help clients and just be there to improve other people's lives.
Fantastic. Beth, I'm going to have you take this first. I I have a wealth management firm. I'm also an active airline pilot. I'm a W-2 income earner, considered high income, and I work with a host of airline pilots that is all over the United States, not one particular airline, but many, many different airlines. They're all W-2 earners, or I should say we are all W-2 earners, and considered in the top 1 to 3% tax bracket, or I should say effective tax rate in terms of a high effective tax rate, 37, 35, 32% tax brackets. A lot of the W-2 employees and workers feel that there is nothing they can do to reduce their taxes because it's W-2. What are some of the realistic tax mitigation strategies for high income W-2 earners?
That's a really great question because at times you have to be creative because you need to stay within the confinements of the tax code still. With that said, the majority of our clients are in that same tax bracket range. When my dad started the practice, it was primarily with physicians. So we are now seeing the W-2s that are around the 37% range as well. Their withholding is pretty significant, and what can they actually do? And I am humble and smart enough to surround myself with people that know much more than me in the office.
That is a secret.
Yeah.
Don't tell anyone.
I remain the personality of the firm, and Barry and our other head CPAs are the tax experts there with their strategies. And it's been really interesting to see what they've implemented over the years. We also work with a lot of people in tech that are just W-2 employees as well, and have to see where we can benefit them too.
And a lot of those
Fantastic. Barry?
a lot of those tech employees have their W-2, but within that, they get restricted stock or they're granted incentive stock options, and they're getting what they think is just nothing because what did you actually get? You can't go to Starbucks and pay with your restricted stock yet. I don't know. They might come out with that in their app, but we have to help them see not only is that real, but many times there are times that they have to pay tax before they ever can use that money. And so planning for those situations, even though that person really is a W-2 employee, the planning can really go a long way into knowing the difference between a short-term and a long-term sale of that stock, because who knows when that clock started without asking a tax professional. And it's just like getting your haircut. You can try to clip your own bangs, but I wouldn't recommend it. You might not like it the next day. And then the IRS will come calling, asking for their share. So
fantastic, Barry. So let's talk about it. I think Beth, in her last bit, said working with really experts like yourself, working with high income W-2 earners. Are you able to title or name or at least identify, give at least a some form of definition or a summary of tax mitigation strategies for high income W-2 earners? This is going to be heard, I'm sure, a lot.
Oh, we're giving our
specifically
secrets.
about this.
Yeah, that's the favorite question, because those are the people that first they have the money to then come and ask for tax advice. And those are the people, like you're saying, that don't have as many levers. And one of the ways that people do it, and a lot of people know a lot of them with maxing out 401ks and things with flexible spending accounts or health savings accounts. Those, we call that the bread and butter. And sometimes people haven't had their bread and butter yet. So we have to at least start somewhere. And that a lot of times is where we'll start with people that are either new clients or are new to their found fortune or improved income. But even after that, you have all kinds of different credits. There's people that sometimes want to donate money. And so we try to strategize how people do that. Now, there's the new tax law that's going to definitely impact how itemized deductions work. It could impact the state and local tax deduction. Now, a lot of people that are at higher incomes may not get the benefit of that increased deduction. But there are definitely ways where if you strategize how to give away money, whether to a donor advised fund, to a charitable, any charitable organization, there can be better timing to save on taxes. So if you're a person who donates $15,000 a year, that's great. But if you do it each December 3rd, you've donated 15,000 a year. If one year you do it on December 31st, and the next year you wait till January 2nd of the following year, you technically didn't give any money in that year in between, but you're able then to say that you donated 30,000 for a given tax year. So just charitable bunching, other types of
Wow.
strategies, those are great ways for people that are going to be doing that money donation anyway to really get a better benefit for what they're doing.
Fantastic. So let's talk just really quick. I actually have a series of questions, but when it comes to tax mitigation strategy, do you prefer the tax deferred account or the tax free account? And I'm specifically talking about a traditional 401k or a traditional IRA versus a Roth 401k or a Roth IRA. If most of the high income W-2 earners, they have employer retirement plans. Would you suggest or recommend them contributing into the traditional 401k or the Roth 401k or 403b for that matter?
Right. So all the different numbers.
Yeah.
It's
But
fun
it's all
once you
kind of
get
the
into
same.
the 401s, 403s, 457s, and people
Sure.
don't know and they interchange them. And ultimately, it doesn't matter as long as, like you're saying, it's tax deferred or not tax deferred. That's a way that people, whether they're currently earning or when they're taking out later in life when they have required minimum distributions, it's just there's only two types of accounts to the IRS. There's pre-tax and not pre-tax. And so, but to your question of whether it be traditional, should it be Roth? We don't have a preference. We're not selling or suggesting any particular one. A lot of times we encounter people who have, fortunately, enough to do multiple accounts and they can contribute to their 401k, they can do Roth. One of the most common things we see is the backdoor Roth. So you contribute money into your traditional IRA that's not deductible because the person makes way too much to be able to deduct that since they already have an employer plan. Now, there are some people that don't have an employer plan. They are making a lot of money. They can contribute to their traditional IRA and take that deduction, but that's usually more rare because we're already in the sphere of doing retirement contributions. But we don't really suggest one over the other. A lot of times,
Okay.
it's just where people feel like landing.
I see. Okay. Do you facilitate backdoor Roth for people, or I should say mega backdoor Roth for people who might have a W-2 income, and then on top of that, they have some sort of a side gig that perhaps is self-employed and subsequently have enough cash flow to participate in their own self-employed retirement account and participate or set up a mega backdoor?
We do see SEP contributions a lot with the work that we're doing. A lot of our physicians also have a lot of 1099 NEC income.
Sure.
Whether they're also a key expert witness in courtrooms or do locum or freelance moonlighting work in the evening. So that's another great opportunity with our type of clients to take advantage of that.
Yeah, because if you're contributing, we don't see the mega backdoor Roth as much, but the SEP contributions, like Beth mentioned, or just other types of self-employed retirement plans, those just knock off a decent chunk of the income that was earned at night or whenever the person does their other type of self-employed income. And so it makes it very valuable. And I wouldn't say people just stop their day job and do it only in that manner, but it makes it feel a lot better. And there's more motivation that we see our clients have to then do a little extra work, which is great for everyone.
Excellent. You've mentioned that you have worked, or is still working, especially in the tech sector, employees, a number of clients, your clients who have received equity compensation in the form of ISOs and RSUs. What are some of the biggest mistakes that you see, and how do you help them in terms of tax planning to avoid these mistakes and get the maximum tax efficiency, perhaps ordinary income to long-term capital gains and that sort of thing? So maybe you could start off by talking about some of these restricted stock units and ISU, what they are, and then subsequently how you help them to maximize tax efficiency.
Sure. So the restricted stock units, the RSUs, and the incentive stock options, ISOs, um, the main component people who receive those miss is that you need to talk to a tax professional or an advisor because you really need to consider making estimated payments. We are seeing clients come to us in their second year of receiving them that had a huge tax bill in their first year. And the penalties and interest alone, when they just pay everything when they file their return, is massive. You need to
Wow.
really consider making estimated payments during the year. It's kind of, we say, like, if you don't floss all year and then just floss the day before you go to the dentist, it's probably not a great idea.
Wait a second. That's
I can floss
terrible.
right now. I forgot to floss.
So just like that, you really want to pay attention to your taxes all year, not just at tax time. And that's why working with a tax professional that also does advisory work is paramount these days for these high net worth individuals with these ISOs and RSUs. We
Mhm.
spend a lot of our time calculating projections, helping them know how much to vest or what that is going to look like within their tax bracket. We see a lot of these tech companies, they'll withhold a federal amount across the board, let's say 22%, during a vesting period. However, the employee's earning is 34%. So now, without their knowledge, they need to make up that 12% difference, and they don't know anything about that. And so when they do file their taxes on their own, they're hit with that difference. And in some cases, it is a huge amount. And the penalties could be upwards of $15,000, if not more.
And just people generally don't understand taxes to begin with, whether it's high earners, low earners, pretty much a lot of people, maybe that's just the people we see because then they come to us. But yeah, people don't know the difference between a marginal tax rate and an effective tax rate. So when Beth is saying 34%, somebody could say, well, oh, I thought last year I was at 22%. I didn't know I'm going into 32 and 35 and 37 when these vests. I didn't know that affects it. I thought I could just pay those at the end. And one of the things that we really help with, like Beth is saying, with the estimated taxes, is sometimes there's ways, especially if people are more savvy and they don't mind thinking creatively, which I think is somehow part of what we're talking about here, where they adjust their withholding because
Mhm.
they can't, at some companies, change the withholding on those vests. Some companies just stay at a flat rate, a 22% usually, but they can change their withholding on their other income. So if half of their income is from restricted stock, and half of it's from their salary, they can withhold 40, 50, 60% on their salary. And they can even do it if you really want to get overly creative, which we don't always recommend, but there are the people that are probably listening to this podcast. You could backdate it a bit where you have low withholding for part of the year and higher withholding the rest of the year. And then feel free to enjoy doing whatever you want to do with that boatload of money that you have sitting around that we know isn't going to be all yours, but why not earn some interest on that as opposed to just paying it away as soon as you have to?
Fantastic. These are great ideas and potential strategies. Do you also talk to your clients who have these ISOs and RSUs? Do you talk to them about 83 type of selections, 83B specifically type
Yeah, we talk about
selections?
83B. I would say that's not so much with RSUs or ISOs. That's usually in a where people are directly investing in companies or they're getting other types of arrangements. We have seen it with some W-2 employees. What
Okay.
we see the most with ISOs is that people first don't even understand what it is. They're getting the option to buy a stock in the future at a price that's predetermined no matter what the market rate is. So even that sentence to most people I would talk to have no idea what I just said. And some people know when I'm saying things, what I'm saying. I've heard not too many.
I'm glad I know what you're talking about.
Yeah, right.
So far, so good.
Only one viewer got it. So one of the big things there is just even explaining to somebody this, what's called the AMT bargain element, the alternative minimum tax, where people don't even know it, especially when they're new to getting equity compensation. They don't know what alternative minimum tax is. They don't know how it compares to regular tax. Some people think it's just extra tax, meaning you pay regular tax and AMT. So there's a lot of things to explain. But one of the things with incentive stock options is you're not even getting that money. You're literally just converting an option that you are allowed to buy a stock to then buying the stock. And now you just have stock sitting in your brokerage account, but you have $200,000 to pay in taxes. And you say, well, wait a second, I thought I wanted to hold on to this stock for a year or 2 years. And sometimes people have to liquidate a substantial portion because the timing of how the exercise works wasn't pre-thought of.
Excellent. Let's move on from the RSUs and the ISOs.
Oh, that's okay.
Yeah, I know. These are the fun
People
talking
love it so
topics.
much.
Let's talk a little bit, just since we're still at this, the PTET, the pass-through entity tax. Being that you're in Pennsylvania, I know that you work with clients not only domiciled in Pennsylvania, but perhaps through many others of the states that have much higher state income tax and property tax. Do you help facilitate or discuss these type of strategies for setting up PTETs? And
Yeah,
first,
did it
let's
about
talk
an
about
hour
what that is. I'll let you
Yeah.
be the expert and talk about what that is first.
Yeah,
and
we
then
like to do that on Fridays.
Yeah,
So-
Fridays is our PTET day. We have other ABC, RSU, ISO days, but today's. So I was just working on a client who they live in Texas and they have a employer that they're partners in, and they file in California and New York. And there's clearly, like you're saying, in these high tax states, the opportunity to utilize that pass-through entity tax credit, which is the PTET, in case that wasn't clear. But it's a way that a lot of states that have high tax rates implement their own tax that was done after the 2017 tax reform, where the state and local tax got severely limited. And people said, well, let's just pay a tax preemptively, and then my ordinary income goes down. So I only get taxed the way I used to get taxed, which is only on the income that wasn't already taxed to the state. And so we see a lot of these PTET credits, usually on K1s. We do have businesses that have that. We're in Pennsylvania, so I would say a lot of our clients are in Pennsylvania, so we don't see it as much directly from the business owner side, but the partners working in big law firms or other big companies that are in multiple states, we'll definitely discuss with them whether it's smart to make that election to participate in that tax return or whether it's not valuable to them.
Okay, fantastic. In terms of just state income, that's state income tax. What about personal property tax, the primary home property tax? Can that be flowed through via the PTET, the pass-through entity tax credit?
That I don't know that much about in terms of the combination of those two things. No.
Okay.
You're just talking about you have a car and you register it with the state and then you call it a business expense that then you can pay the state tax to save on your federal tax. That would be a little outside my wheelhouse.
Understood. Thank you. So for clients with equity in real estate and having rental income or multiple income streams, how does working with a CPA team like yours give them the edge over using do-it-yourself tax software?
We have a number of clients that, in addition to their W-2 income, have one to multiple rentals. One client in particular I'm thinking of has 4 rental properties in northern Florida. We help them through that, working with depreciation ideas and working with sometimes even their management property team. Sometimes the management property teams aren't reporting things properly for them, where we have to make sure that their real estate taxes were paid. Was there an HOA fee this year that isn't being picked up? Hey, I didn't see the insurance line item. And by working with us, we can go back and talk to the client and say, hey, you got this P&L from your property manager, but there's some pretty important items that aren't on here. And sometimes it's just a coding error on the bookkeeper's end that they're working with. But without someone who's trained in this, you can very easily miss a lot of expenses that you should get and you're entitled to take.
And I'm sure we could talk about stories all day, but we, in the last few months, had a client who came to us and we noticed that when they had filed their state tax return, that because they had a property in another state, that there weren't state tax return spot. They didn't live in the state that the property was in. There was no state tax return for that rental file. So we said, okay,
sure.
well, we probably might need to file that depending on the situation. But then we go back and we see their federal return had 2 properties listed. And we said, well, I thought you only had 1 property. And it turns out that the way that the documents were provided to the accountant were from 2 different sources. One was a P&L, one was a 1099, and there was questions that random numbers were written in. And so they had double the income reported for 4 years. And we said, well, we have to fix that. That doesn't seem the right way. And the challenge is a lot of times people don't always pay attention to those finer details, even if they are doing the taxes themselves. And sometimes if they come from other accountants, we try not to laugh too much, but we know that people make mistakes, and sometimes those mistakes cause a lot of challenges, and we try to prevent our office from doing that first off, but then being able to be ready to help others when they've had that challenge.
Yeah, the due diligence that a proper accountant and advisory firm can offer is fantastic when you're just trying to do it on your own because you feel that you should. I think sometimes there's a stigma, oh, I should know how to do my taxes. Well, how? You learned geometry and parallelograms in high school. You didn't learn taxes.
I know what a zebra says.
You didn't learn about
tax. You don't know.
Yeah, right.
People come to us and say, what don't I know? And first we have to say, well, what do you know?
Do you know?
And they don't always know what they should know.
And unless you went to CPA school or a tax course or for years, or have a diploma in it, or at least get some designation that we talked about in our pre-podcast discussion, you don't know any of this, because this is not you're not born with this knowledge off the cuff.
Fortunately, on the tax return, if we're still talking about rentals, there are lines that say what the expenses are, which is nice of them to say.
It is
rent, cleaning, maintenance, repairs. Depreciation is a big one that, it's on there, but what does that mean exactly? And then there's other. So there's plenty of others that people may not think of. And then very importantly, like we're discussing with depreciation, somebody could own a building and make some improvements, and then somebody buys that building, and then that person doesn't always know what can be depreciated over what life. And so we know buildings can't be depreciated all in the first year. You can't buy $1 million building and then deduct $1 million. But there are definitely components to buildings that can be deducted in the first year. So there are things like a cost segregation study, where you hire a firm that knows the difference between a desk and an HVAC and how that all plays together. Because you don't know that right away. You paid an amount and it's all, I don't know what it's for.
So in your opinion and in your guesstimate, how many CPAs in the U.S. would know about
600,000? Oh, I thought that was the
600
answer.
CPA.
I
Okay,
knew that, but I'm not going to know the next part.
How many of the 600,000 certified public accountants will know about cost segregation, and then to subsequently provide the information, hey, you should participate in a cost segregation study to help that?
That's a really good question. I understand. I think when people think of accountants, they think of a tired, lonely person sitting in a dark room, crunching numbers, pulling the lever forward to get the bottom line answer.
Don't tell them you do that.
In a lot of ways, I feel there's like almost this stigma around boring accountants just doing the same formulas over and over again. And from a really great conference we attended, we heard the great phrase that the accounting world is fairly pale, male, and stale. And something that we bring is that we're up to date on everything. We like the new technology. We like learning how AI can do things. We know what the accounting firms are like around us, also nationwide, because we get clients from every state all year long. And I would say an overwhelming majority is still not doing things that they can for their clients, because they're so set in their stereotypical rigid accountant ways, where we like the game of it. We like the fun of it. And we also have young kids and want to keep working. So we're also not going to do anything that you shouldn't do. And so we really like feeling like we're helping our clients win at the game of taxes.
Yeah. And of those CPAs, that I think it's 0.6% of Americans too, which is all, it seems like a lot, but maybe it's not. Not all of them work in taxes. So I've had many CPA friends who do audit and plenty of other things that people say to them, can you do my taxes? And they say, I don't know how to do my taxes. Just because I'm a CPA, it was a small part of the exam. And so of those CPAs that do taxes, not all of them work in the personal space. And so you keep narrowing it down. So if you have a group of people that do have experience with rentals, I would say most of those people do know what a cost segregation study is. I'd say
Okay.
probably a very small percentage of people who know about it do it because it's a very specialized thing where people actually go to the site and they measure things and they check. There's a certification. I'd imagine that you would probably know, you're a very good certification expert, but there's a limited number of people who know about it, and there's an even smaller limited number of companies that do it.
Absolutely.
But it's very valuable. You can get tens of thousands of dollars on a property just like that.
Yes, there's a couple of companies that I can think right off the top of my head that this is what they do, and they guarantee audit potential. If there was an audit, they stand behind their work and
Because they're not doing anything wrong. They're just
that's right.
going through and performing a deep, thorough clean to say, well, where are the termites? Let's get rid of those. And
Right.
now that things are cleaned up, now you can live here. Now you can enjoy this property for what it was meant to be for.
Absolutely.
But
So
under
let's talk.
repairs and maintenance.
So let's talk a
Don't do
little.
that.
Let's talk about the OBBBA, the One Big Beautiful Bill Act.
Which is
That just-
technically not the official name of the bill. In the last minute, has been struck from the name. Not that I need to
Oh,
clarify that
okay.
for any reason other
Well,
than
it's the
it was
it's
cute.
the it's the 2.0 version of the Tax Cut and the Jobs Act that made a
Yes.
lot of the 2017 tax changes to become permanent.
Mhm.
Can you each provide your opinion of what you like and what you don't like about this new permanent tax bill that was passed?
That's a fun question.
I hope so.
Not loaded at all.
Sticking as a tax professional to
Okay.
answer this question, our type of high net worth client is going to benefit from this bill,
Mhm.
specifically from some of the new SALT information, the state and local taxes. Our state in Pennsylvania, we have a local tax as well. Barry can talk more about that, and as well as bonus depreciation. That's something that's really going to play a big role with this bill and with a number of our clients that we're going to do some tax planning for and strategizing before the end of the year.
Yeah, there's definitely the rates themselves. It's one of those things where it could have gone up, but the fact that it stayed the same doesn't always feel as exciting. To be able to stay on the ride isn't always as good as getting on a new ride or getting on something better. So the fact that the rates stayed at 37% and they were made permanent, and the way that higher income earners still have that pretty substantial 3% is a lot of, if you talk about a large number and take 2.5, 3% of that, we're talking about a large number. So that just in and of itself may seem just as one of the small components, but that's probably one of the biggest ones. And even though you can deduct bonus depreciation, I would say that was probably going to always be somehow continued. Everybody loves that, but it is also in that bill. And then we don't deal with it as much directly, but there are a lot of good things for the tips and the overtime and the additional standard deduction. It's the tax side of it is just helping people pay less taxes. Now, that's good for us because then we get to say, hey, we saved you on taxes, not by what we did, but what happened in the world.
Sure. I like to ask you on a follow-on question regarding this. With our current nation's federal deficit being where it is now, over $37 trillion, with over $200 trillion of unfunded liabilities, there's actually a website called debtclock.org that shows all the debt that the nation owes. And now with this type of tax bill that has passed, which helps lower taxes for the people that we all serve, this is going to lessen tax revenue, which could amplify the deficit. How do you look at this and not necessarily or not have a conflict, or have a conflict? What's your take on that? For this question goes to each of you.
Well, there's definitely dissonance about if you have cake and it tastes really good. we know it's not good for us, but I'm still going to have it. I might not have it every day, or I might not have 5 slices. But
Okay.
if we're the chefs handing out the cake, people will still like us. The challenge is, and I do have an economics degree, but that's about the extent of my real understanding of a lot of this,
Okay.
is that the idea is that even though the rates go down, if the economy grows, then the total tax revenue can go up. Now, from
Okay.
my understanding, that hadn't happened in the first 8 years, and who knows what'll happen here. But more importantly, being able to lower the deficit, how realistic can that be? And what would it mean if we just say had no debt? Because the US is the reserve currency of the world. So if we had no debt, then our currency isn't being floated around as much. So there is still important to have debt. I'd say the deficit being better is always it's just a general income of the year. It's good to feel that we're earning money in a given year as a country. But yeah, I definitely don't try to get too involved in it, other than saying, hopefully we can figure something out, but I don't think I'm going to be the one to solve the nation's fiscal crisis.
Okay. Beth?
I feel that with most issues, there's the emotional component and the logical component. Logically, I guess in both, I don't feel our deficit is going to improve. Emotionally, that upsets me, but looking at it
Mhm.
as a tax professional, I have to stay in my lane of the logistics of it. And how do we benefit our clients? How can we continue to mitigate tax burdens for them within the new parameters of what we have to work on? Our 2,000 plus clients paying their taxes properly, even within the mitigation techniques we can apply for them, aren't going to save the world.
Mhm.
We have tax capes, but we don't wear them.
One time we did a data mine where we saw exactly how much our clients pay to the government. I said, good for us. We are
Yeah.
the messengers for that substantial resource provided to the Treasury.
So knowing that $37 trillion mark, our clients are paying pretty significant share of
They're
it.
doing at least a quarter of it.
Got it.
We're just going to keep doing our part. And, we didn't make the bill. We don't make the tax code. We just have to follow it and understand it in a way that benefits our client.
We stay in our lane and keep things small and don't over globalize our impact in the world.
Fair enough. Fair enough. Okay. Let's move on. So, Barry, what are some of the most common tax mistakes that you see that people make that could easily be avoided with just simple better tax planning?
Yeah. So first of all, coming to us in April and saying, hey, I want to have a meeting to lower my taxes is probably the number one thing that not just me and not just Beth, but other people in the office now have finally realized is something we try to instill in almost any interaction that we have, that we say, hey, it's a great time here in September, even though we're getting towards the extension deadline. It's a great time. Come in, let's chat, let's think of some ideas. Maybe David will come on and talk with us about ways that we can change things before the end of the year where it still matters. Because in January and February, thanks for giving us your forms, but it really should just be putting on the finishing touches. We shouldn't be remaking the whole car in April. We should just be putting a little polish on it.
And Beth?
I feel that your W-4, when you fill it out, is not set in stone for life. And
Okay.
having your pay stubs evaluated by your tax professional maybe twice during the year is really important. Making changes to it and to your federal withholding is something that we don't see enough of our new clients do. When they come to us, they just think, oh, well, I chose the percentage withholding. And since then, they've gotten married, their income's 3 times higher, and they have 4 kids.
And if they move to a different state,
Mhm.
sometimes they don't even have their state withholding changed. And fortunately, a
Wow.
lot of people do reach out to us after they move or after they have these big life events. But I'd say a lot more of them come to us after that whole thing happened, and there's not as much we can do in the short term to help them.
So letting us be involved throughout the year is a really important step that individuals can take, not just showing up with their finalized tax documents in the winter months.
Yeah, because penalties are just ridiculous. If there are ever penalties on a tax return that we've worked closely on and we've talked to a client throughout the year, I would be very disappointed in
High
myself.
net worth individuals not making proper estimated taxes, their penalties will save the country.
That's true. That's a good way.
Wow. So as you have clearly stated, April is not the best time to start thinking about taxes.
Please don't.
What
Think of
what
it away from us. Think of it.
what is your compelling message to the clients that you serve and the people that are listening and watching this podcast about making tax planning a year-round strategy?
Reach out. We reach out to our clients. We check in with them throughout the year. We have lists on lists of who needs what from us and when. We joke that they're quarterly estimated payments, even though they're not fully paid on a quarterly basis. So we are working on that. We have our list of clients we reach out to for pay stubs, see what's happened in the past quarter.
Wow. Proactive. You're very proactive.
It's important. It helps make that relationship. There's some clients that there's a lot of consistency. We will just generate safe harbor for them, or when we do their estimates, just base it on their prior year return and split the payments evenly through the 4 quarters. But more that often than not, our clients need to be making very specific quarterly estimates based on what's going on in their financial world.
Yeah, if they're vesting and their vesting schedules aren't always the same each year, if they have a 1 year cliff and then they vest over 4 years and then they're working there for 6 years, well, maybe that fourth year is going to be different. Or if they get another grant of shares, we like to be aware of what's happening ahead of time, because just the penalties alone are crazy. But then to not be able to know what's going to happen is really, from a client relations standpoint, we don't like being the bearer of bad news when we could have been talking about it for months and months. And we think part of the extroverts doing taxes, we like talking to people, and we're happy as long as you don't call us over 5 times a day. We're not going to be upset about it.
So your firm definitely prides yourselves in relationships, and the relationship that you have and the relationship that you will and continue to build. You say clients is part of your Goldstein family. How do you build that trust and the connection that carries on a generational level?
Well, the client has to want that type of relationship too. Not every potential client is going to be the right fit for us, just as we might not be the right fit for someone else. Our feelings don't get hurt. Sometimes theirs do, because they really want to work with us.
I don't know about you, but
but I really take the way my dad built the practice to heart and try to maintain that level of relationship and professionalism that he showed to our clients that have been with this firm for over 40 years. At times I say we're running 2 firms, right? We're running the firm with the clients that were with my dad and that I get to maintain those relationships with. And there's something really special there. There's also something really special about creating relationships that are ours, that are new, that we get to form and forge and move ahead with, and really be there for them through their, times in their life when they're having their first kids and should they change their withholding, and I think I'm going to leave my big tech firm and try to patent my own app, and helping them through those processes. We're supporting our clients through all the milestones in their life. And I remember my dad doing that as well. And we don't remember our clients' names and where they go to college to look good. We actually care. Plus, it's fun to see the tuition at all these colleges on the 1098.
That goes up.
Because my daughter's 8 and Barry and his wife have a son who's almost 2. And I keep thinking something has to change in the next 10 years.
The projection is high.
Wow. Let's transfer just a little bit to business owners that are looking to retire, and they're possibly either passing their businesses like Bob, who passed it down to you, Beth, but other business owners who's looking for liquidation, to sell their business and moving on. The new tax bill, I should say, the 2017 tax bill, which has been improved in 2025, IRC tax code 1202, the qualified small business stock. Do you work in that realm? Do you have clients currently that are looking to possibly sell their business utilizing this type of a tax mitigation strategy?
Yeah, we did one of those, at least one that I can remember within the last month or so, where
Fantastic.
Yeah, one person was one of the first employees at a company, and they had several $1 million that's coming to them and they're paying no tax, which is probably the ideal outcome in this topic that we're talking about. And like you mentioned, one of the improvements has to do with the timing of when the shares were acquired. One thing to note, though, is that when we're saying business owners selling their business, qualified small business stock, that 1202 type capital gain is very narrow. I wouldn't say it's overly narrow, but it applies to C corporations that you have to be the original holder of that stock for a pretty decent length of time. And so you had to have a certain asset test. And for sure, we see it and it's possible that situation happens, but I'd say it's probably not as common. Unless you watch the news, you could always see that one thing. And we've had clients that deal with it. It's not an everyday occurrence.
Excellent. And you've helped facilitate this 1202 transaction, and you have at least a working knowledge, if not a clear understanding of the methodology of the path to this
Absolutely.
transaction.
Yeah, we have clients that come to us that have that situation, and a lot of times we're just advising to say, does this qualify? That's probably the most important question, because if it doesn't qualify, then forget it. And if it does, then we'll figure out the particulars of how to report it and where it goes. But once people know that they're getting $5 million and paying no tax, they're very happy to hear that we're asserting that. Now, we never want to say for sure, because then you never know if that we don't want to be held liable for terrible services, which we never have. So let's keep it up. But it's a big decision. It's a big call to get this person. When I called him and said, yes, that qualifies, you're going to pay no tax on $5 million. I don't know if he cried afterwards, but I would think that would be a really good call.
I would cry. I'm crying on behalf of them and joy that they didn't have to pay the taxes, any triggering of taxes on the sale. You're passionate, Beth, of helping people and building a financial team and not just being a tax preparer. Who should be on your team and who are on your team, and why do they each matter?
We like to feel that we have something very unique here in our office. We could very easily just be a remote firm and not come into the office. For those listeners who are listening by watching this, you can see where Barry and I are sitting next to each other. We like to be in the office together. Granted, he has his own office back behind me. If you
I don't know.
come down the hall.
Yeah, I do work a lot.
But it's important who you choose to be on your team and part of your family. You're spending more time with the people you work with than your own family. I have to credit my husband, the way he takes care of our daughter during tax season. But who we have in our office is people who like to be around other people.
Okay.
We like to make the phone calls. We like to sit and have lunch together. We're starting our 6th year of having a school year internship program.
Oh, wow.
We have some really
Great.
phenomenal universities in the Pittsburgh area, and we have school year interns that start with us in the fall based around their class schedule and stay with us through April 15th and get really practical accounting experience. As Barry mentioned earlier, there's so much you can do in the accounting world that it's a great opportunity for the students to really get a sense of one of the paths you could take. Something else we've done being a younger firm and creative is that we're not only looking to hire in the Pittsburgh area. We have 3 phenomenal full-time CPAs that work with us that are in states that we have the majority of our out-of-state clients in.
Which states?
We have Florida, Illinois, and South Carolina. We have a number
Fantastic.
of clients who are retiring to South Carolina, have a second home in Florida. We have to really figure out, okay, did you spend more than 180 days in which state? And so having these specialists in their field of their state, we're ahead of the game in a lot of ways. We're not only hiring the best people we can find locally, but around the country to really benefit our clients and support them in the most appropriate way.
And they fit into the mold that we do here, so they continue that service style, and we're not running 2 different types of firms. We don't have an in-office and a remote. We get to blend it together and operate as one team.
Fantastic. So Barry, between mediation, comedy, and volleyball, you clearly bring out personality into your work and to the firm. How does your approach help put clients at ease when they might be stressed about their finance, which includes, of course, taxes and other financial subject matters?
Xanax in the drinking water.
I'm supposed to put, yeah, I didn't know I was supposed to put them at ease. So maybe that's a good strategy.
Okay.
I like them being really nervous and frazzled. That's much more fun for me. But no, I lay it out. And a lot of times if it's not good news, I have to just say it directly and talk through it. Sometimes we like to think we're just social workers that help with taxes because there is an emotional component that is very important. And there are times where people have difference of philosophy of do they want to owe money in April or would they rather pay it evenly? And people could have an identical situation, but not all people are the same. They have different character and interests, and just getting to know them and listening. And I've been told I'm one of the best listeners is very helpful.
Is that from Beth or your wife or?
I would say he's getting better. All we can do is learn from any mistake any of us have ever made.
Sure, of course.
Just to share, my biggest mistake I made is a client one time mailed us their extension payment check, and without looking, I endorsed the back of it with our office stamp. And so,
okay.
just a good reminder to slow down. We all make mistakes, and just don't make the same mistake twice. And we really pride ourselves on the service we give to our clients and the care we give. We're not just going to call someone and say, "Oh, you owe 200,000."
Depending on who it is, they might say, "Wow, that's it." But we instill that on our interns too, is to just be good and learn a lot, and you're not gone if you messed up once. Like if you do it twice, maybe, but once is fine.
Once is okay. All right, it's forgiven. So we've talked a lot. We talked a little bit about charitable CRTs, charitable
remainder trust.
That's it. Hang on one second. And action. We've talked a lot on the show about CRTs, charitable remainder trust. We talked about RSUs. We talked about ISOs. We talked about PPETs and QSBSs. These are all acronyms, and these are all going to be in the show notes. So for those people that are going to be Googling this type of subject matter, this is going to come up. This is going to pop up. And so for listeners who's been doing their own taxes and wondering if it's time to bring in a professional, and the professional that they should pick, what's the tipping point, and when should someone give you a call?
Well, once they know they feel overwhelmed, they should do it immediately, because why stew in that discomfort? And if you're going through that list and you're going A to Z and you're dealing with a lot of them, once you get to B or C and you're overwhelmed, why do that? We work with all different sorts of clients of different income levels and wealth levels, and we help to whatever tier of hand-holding or involvement you'd like for us to be in.
This is a great time of year to reach out. We're coming up on the third quarter estimates. Probably a titch too late because most tax professionals are now dealing with the September 15th business deadline and then the October 15th personal deadline. Something we pride ourselves on is the nonprofit work we do as well. So we do have some 990s to finish up this year. But this is a wonderful time of year to reach out and find the tax professional that you fit with, because you can still absolutely and should probably make a fourth quarter estimate by June 15th, January 15th.
The calendar quarters are all messed up, I know.
We did make a June 15th payment, but this would be for the fourth quarter of January 15th, 2026. Do not call to become a new client with someone in March. There's nothing anyone can do to help you. Yes, we or whoever you reach out to could get your taxes filed for you. It's probably not going to be a great outcome for you in that year, but moving forward, that tax professional could work with you to mitigate your tax burden in a more advantageous way. But I imagine most people listening to this are savvy enough to know that this is the time of year to start thinking about year end already.
Yeah, figure out the year end before the year ends. And we're here all year round to help with that.
So for those of you that are watching and listening to this, do not procrastinate. So where can listeners and viewers connect with you, learn more about Goldstein Tax Advisors, and or schedule a consultation with you?
Well, my first answer is outside of tax season, I like to travel a lot. So it's very possible that some of your listeners have been my pilots before.
Fantastic.
2 hours. I'm not nervous that I'll make it on time at all.
Our website is goldsteintaxadvisors.com. We also own the rights to Goldstein Tax Advisors, in case people don't know how to spell advisors. So it'll still direct you to our page. At the bottom, there is an inquiry that you can submit. Let us know that you're interested in having an intro phone call, and we'll get the link sent over to you, and we'll see if we seem like a good fit to work together.
And there's a great video of a typical client visit from when her daughter was 3 years old, showing what it'll actually be like. You could also just Google
Fun.
us, whatever is easiest for you.
Great. Would you please be able to provide your email address?
Yes.
Yes, our email address is tax, at goldsteintaxadvisors.com.
Also, tax advisors with an ER would work in that case.
As it will forward to us, we own both domains, since advisors seems to be a tough word for some people.
So for those of you that are watching this, it will be on your front
You click it.
screen.
Okay, good.
And for those of you that are listening to this, it will be in the show notes. Any final words, Beth?
Accounting's a really fun profession. We get to work with really great people. We get to still enjoy our families, and we get to watch other people enjoy their families by letting us do their taxes. A great line my dad had was that sometimes you need to let someone else drive the bus. You should let a tax professional drive the tax bus for you.
Yeah.
And Barry?
Yeah, I would say just being able to know when you need help is a good, it's not a negative thing. There shouldn't be a stress about needing help. There should be relief from getting help. And we see it as we're able to help. We do this all the time. We have a lot of expertise in this. And so if
Certainly do.
that's something somebody isn't wanting to learn, if they're not looking for ABC and AMT and RSUs, they don't have to learn it. We have clients that don't want to know anything and they just sign. And we have clients who will spend hours and hours with talking about a certain line on a tax form.
Fantastic. Well, that wraps up today's conversation with Beth Goldstein and Barry Kaufman of Goldstein Tax Advisors. I hope you found this particular podcast insightful on proactive tax planning, avoiding common mistakes, and building a strong financial team, both practical and inspiring. If you'd like to learn more about Beth and Barry, it is in the show notes. And also check out the links that is on your screen. And while you're there, please be sure to subscribe to Jet Setting Wealth Advisory so you never miss an episode with experts just like Beth, just like Barry, who are who are redefining wealth, success, and financial freedom. Thanks for tuning in. And thank you. Thanks for tuning in. Until next time, keep jet setting toward your financial future.
Thank you for flying with us on today's episode of Jet Setting Wealth Advisory. If you enjoyed your journey through the fiscal skies with David T.U., don't forget to subscribe to our podcast and keep your financial knowledge soaring. For more insights and personalized advice, visit us at www.dtywealthplanningsolutions.com and connect with David directly